Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to Trends with Benefits, Joe, and welcome, listeners. Let me just stop there. Welcome, Joe.
Thank you. Thanks for having me.
I'm speaking with Joe Mallen, CEO and founder of Modelist, and we'll be talking about models and markets and kind of everything in between. You know, I was thinking about your background and kind of a quantitative finance background. Does that also mean you're kind of a techie? Do you like tech things?
I wish I was better at it. I like it, but I know how to use things. I don't know how to build them that great. I'm dangerous with VBA, but get me into Python or anything like that, it's foreign. I've always said I'm a kind of a quant that still has interpersonal skills and can talk to people.
That's a good way to think about it. No, I was thinking about that because one of the things I want to ask you about is AI as well. You know, I don't know if you've, I've just recently bought a house and renovating it, and I'm trying to turn it into a smart home and replacing switches, learning a lot about electronics or electrical wiring, I should say, and smart switches. You know, but I found that they're all on like different apps, like the app for the switch maker, an app for Google Home or Siri or Amazon, and they all do different things. And just kind of wish there was like one app that you could program something, a bunch of if-thens, and make it do what you want to do, as opposed to some pre-programmed or canned activity or routine.
I'm the same way. I have the automated shades, the Wi-Fi routers, the TVs all hooked up, the security system, all on different apps. They all break.
Yeah.
Like Google Home does it, Apple's trying to do it, but they're pretty incestuous with the products they'd let into the ecosystem. I think if whoever figures that out, it's going to be awesome.
Yeah. It's frustrating at times, but I love doing it. But at the same time, I'm always checking the apps, like, how come that light didn't work? You know, something's always going on with it. But in a way, I think, you know, maybe there could be an AI solution there. And I was kind of wondering, just in general, are you getting caught up with and or following a lot of the AI headlines and news like everybody else is?
I try to keep up. I mean, I love it. I think it's cool. I use it every day. I just tell people starting a new business, having access to like ChatGPT has replaced probably the need for a few analysts on a team or even interns. I mean, I remember my first job in the industry, I spent maybe a good year building a way to automate client reports out of Excel with VBA and tried to figure out code and read through books. Now you go into ChatGPT and you simply say, I want to cycle through the list in column B, have it modify C, D, E, and F, print out, look up the email, PDF it, grab it, put it in. And you can just tell ChatGPT, you know, as you would say it, and it gives you the code. Is it always perfect? No. But man, that used to be weeks and weeks of time. Or, you know, getting bullet points from an article to put in a blog post, or how do you structure a deck on how to explain your company? What are the important points? ChatGPT gets you off and running. I mean, it's amazing. Beyond that, as far as implementation in different industries, that's way beyond my skill set or expertise. But I just think it's so cool. It's created so much efficiency. It's not going away.
And thinking about kind of AI and you know the hype cycle that goes along with a lot of that stuff, and just being in investments ourselves. What do you think about AI as an investment theme?
I think it's huge. I mean, obviously, right? It's one of the huge topics of 2023. It's going to be for the years to come. The question always is, you know, how far ahead of ourselves have we gotten? It's probably tossed around a little too liberally. You know, people can throw the word AI just like they can throw the word crypto in front of something and try to make their valuation greater. I think there's something there, and especially for the people that, I'm going to use this analogy, build the calculator, not know how to use it. It's a saying that my high school calc teacher told me, because we would all say, hey, why do we need to learn how to do this if we can just use a calculator? And he told us, he goes, the people that make the real money in the world aren't the ones that know how to use the calculator, but know how to build it. I think that's kind of appropriate for AI. So the folks building the real IP, you know, the Microsoft, the Googles of the world, I think they have a huge advantage. People just learning how to use the calculator, I think that's going to be commoditized pretty quickly, in my personal opinion. But I know oversimplification of the whole concept, but that's where I see the real winners in the space.
Yeah. Well, great. Listen, thanks again for hopping on the podcast, and I'd love to talk to you about Modelist and kind of what you're seeing in the industry. all of those things. I don't know, maybe you can give me a little bit of background on yourself and kind of walk me towards how you got to launch Modelist. And by the way, when did you guys establish Modelist?
Man, the firm, I started in June of last year. One of the biggest challenges was getting up and running and registered and, doing all of the legal work. So we've been a registered RA since November of last year. We're a few months into this, but we're off and running and got clients, got assets, and everything's going great at this point.
That's great. What trends were you seeing perhaps in the industry or in the marketplace that led you to go on your own and start this firm?
I use this analogy. I think it's important. If you bear with me for a minute, I was fascinated by direct indexing and the value that it brought to financial advisors. So when I describe direct indexing, it might not be the way they sell themselves, but an advisor, if they wanted a stock portfolio, they could build one. Often that's not a very good idea. It's not their expertise. And, what kind of quality you'd get building a stock portfolio. Or you outsource that capability to a third party, right? A mutual fund, an SMA provider. You give up your brand, you give up your identity. It can be very expensive. I think direct indexing came right into the middle of those two and enabled advisors to say, start with a baseline, start with the S&P 500. Now, based upon your clientele or a specific client, let's take out some industry. Let's take out tobacco, guns. Let's put a value tilt. Let's put a momentum tilt on this thing. And at the end of the day, what spit out was, here's a narrative. That's me, the advisor. I did for my client. I'm selling myself, my brand. And the cost has come down quite a bit, I think, from a traditional high quality SMA manager. I saw this concept of all of these companies are getting in the space of enabling advisors to build custom solutions. Nobody's doing that in the model space. And what I mean by that is more advisors are using asset allocation models for their clients. They're not building 500 stock portfolios. So what do? They either do it themselves. They subscribe to Morningstar, pick mutual funds, pick ETFs, do whatever, create their own logic for rebalancing. Or you use a third-party option, a model portfolio, an OCIO, all of these things that exist, but you're giving up your brand. There's low-level customization. You're using the funds that they recommend, force you to use, and nothing's white labeled. Modelist is that middle ground. So we are building the direct indexing for model portfolios. We start with baseline asset allocations, give people our IP to help them modify and move the tacticalness of the model, customize the holdings that they own, give them all the content and updates when necessary under their own brand they white label. I know that was an elongated answer, but that's kind of the passion and the reason and the void in the industry I see right now.
Yeah. Or did you see trends in terms of model usage in the industry that kind of just supported the launch of the firm as well?
Yeah, I didn't like the solutions. And I just put myself in the role of an advisor. And what would I do? I think I like the idea of doing it myself. And if I'm $1 billion+ RAA, I can do that. I can hire folks to do it for me. But there was always some conflict of interest with every other solution. So 2 roles ago, I was a CIO at a TAMP platform. And I was tasked with building out a model manager lineup. But in talking to these advisors, we're selling them like, hey, you have to outsource these third-party managers and combine them together. And this one's really good at trend following. And this one's a fundamental bottom-up stock picker. And you kind of smash all this stuff together and you're like, what is this? I kind of believe it, but they don't really fit. That advisor's confused. They don't know what's going on. But it's what they did. They said, I need to be outsourcing. And then your free model providers, BlackRock. I know you guys offer models as you should. But if the same person's picking your model and running your funds, so there's an inherent conflict there. And then lastly, I just see other options now kind of coming into play of, we're going to build a really expensive fund and then give away the model for free. It's just such a conflict there for me of, would you pick your own fund unless you had to? So I get it's a free model portfolio, but the expense ratio is now 60, 70 basis points. So I didn't think there was an option there for advisors to say, give me a level customization, but donate all of your IP to the equation. And let's work together. Let's build something that's really nice, that feels like me, that's flexible. I can retain my holdings, not afraid to go super low cost if need be. and do it at a basis point charge that's fair and true to the value you're providing as a model provider.
So if I was an advisor that loved the idea of trend following, for instance, and, like kind of that active model, I could come to you and help develop something in that regard. You don't have a particular bias towards one type of model or strategy.
Not at all. We have a library of about 30 today, different strategies. And these range from standard asset allocation, stocks and bond ETFs, mutual funds, 15 holdings, to, like you mentioned, trend following, relative strength, traditional factors like quality, value, economic data, looking at like inflation, projected growth. All of these things are we design and we make fully transparent and give that to the advisor. It's like a lot of folks out there in the model world are doing trend following. A lot of them charge 50 basis points for the spreadsheet they built 10 years ago. And that's fine. I respect them. It makes sense, but it's not a secret. And we put that out on a table and say, this is how trend following works. Here's the pros to it. Here's the cons. Let's build some expected tracking error in your model and how to utilize it. I want you to be aware of this. I never want you to apologize to your client. All of those things combine to really help create that design for the advisor and utilize those techniques and know what they are, how exactly they work, and when signals change and why they change.
In your experience in doing due diligence on different models and helping now advisors build different things, I don't mean to try to extract some bias from you, but just kind of curious, have you seen certain things that work better than others? And maybe it's time frame dependent, but are there different approaches that you find, like I said, work better than others?
I hate to say it's somewhat dependent on the advisor, really what they're trying to do, but I like to look at things in the really long term and understand when they work and when they don't. And I favor things that tend to be pretty resilient across all market cycles. And if you look at an analysis of a strategy and you look at the 1, 3, 10, 20-year return, and you look at alpha, there's stuff that jumps off the page like, this is killer. I want that. But I can show you in the back test or in the history points in time in which the client would probably fire you because you underperformed so dramatically. And those couple hero moments are great and they counteract those, but can you live through it? Can you really experience that? So I know it's not a direct answer to your question, but in that regard, like relative strength and rotating across asset classes and looking at quality of asset classes and economic growth expectations, overweighting growth and value based upon a simple metric like aggregated economic indicators. These things are pretty resilient to market cycles. They make sense when they outperform and when they don't. And that's really where we tend to lean. And those are the advisors we're trying to attract. Right? We don't want to have, build me the next best thing and I'm going to go tout it to my clients how I solved investing. No, we want something that's pure, honest. You'll always be able to explain. It makes academic sense. It's documented. Those are the checklist of things we look to build.
And when you build a model for somebody, then is it ongoing? After you build it, is it just delivering them the signals on whatever frequency that they need so that they can trade it? Or do you do the trading for them? How does that work?
Both. So we call it like a consultancy relationship where we build the design and then we deliver the model when trades occur. We uniquely draft a trade rationale and a fact sheet for every model that we design. So that advisor not only gets the trade update when it happens, but also gets a narrative. We're adding 3% to high yield bonds because XYZ is happening in credit spreads. We're adding long duration because of the slope of the yield curve. So everything is rules-based and we're very proactive in the communication when it happens. We tell them why, and they should recall, this was part of the design. I get it. This is what's happening. So that's the deliverable. Or we can do the execution. Do all of that same work, but when it comes to actually executing the signals, it just happens. And we can use third-party partners to do that, or we can do it ourselves. And we can add, a little more frequency in terms of trading and things like that. We don't want to be sending people trade files multiple times a month or every week, potentially. But if we're doing the trade execution, we're more comfortable doing that.
Are the models and or back tests developed on existing tradable products already, or are they based on indices that then have to find a product to fit?
A combo of both. What we try to do is more often than not, we'll use an index just to get the longest dated back test we can do. And the goal of our back test and building a model for a client is around an index design. So think of it as we're building a custom index for that client's model portfolio. Then when it comes to execution, they use exchange listed tickers, obviously. Is there going to be difference in performance and description? Of course. But if we limited ourselves to the ticker, our back test doesn't go back as far. So we're just trying to equip them with the most relevant information. So there's the design, and then there's the execution, and then we monitor the tracking error between the two.
Now, has there been a trend of the types of models that advisors are asking you for recently?
There has. A couple of the more popular concepts right now are trying to get away from looking at things like inflation. We have strategies that have done that relatively well from a backtest standpoint, but do we feel inflation is the major driver here going forward? Not really. One popular strategy we have is like a cash plus strategy. So it fits that advisor that says, I have a retired client, they want the income, and they're super risk averse, but I don't want to drop them in a money market. So we creep up the efficient frontier a little bit, throw some leveraged loans, short-term bonds, maybe some short-term high yield, dip our toe into some other asset classes to give them a little cash plus return. And as much as painful as it was to have rates go where they went, we were gifted some yield for those type of folks at this point. So very popular strategy, boring, I get it, but it's useful. I think that's what we're trying to do, is just equip these buyers with things that they want, not sell them something, build what they need. And we'll continue to do research on that. Those are the types of things we talk about. We want to build a bite-sized strategy, tell the client exactly how it works and how that will modify an otherwise diversified portfolio, and drop it in.
Yeah, one of the other big demographic trends that we are dealing with in the U.S. is a retiring generation. Have you built models yet for those kind of people, for like retirement models or distributing portfolios?
Mm-hmm. Yeah, and we try to be flexible. So we'll do things for qualified, we'll do things for non-qualified accounts, and we encourage advisors to keep it simple, have one model for each risk level, but maybe have a different version for the taxability. Let's get a little more tactical and a little far-reaching in qualified accounts, but in non-qualified, let's be tight. We don't want to penalize a client just because we're ignoring the negative tax impacts. But then also, like you mentioned, someone in the actual retirement phase, we want to produce income. We have, not only a cash plus strategy, but we have, it's called an enhanced yield strategy. So this is a way to take an otherwise diversified portfolio, but let's juice up the yield. And we'll introduce things like covered call writing funds in the allocation, high yield, different type of buffered products. There's different products that we can introduce that don't necessarily fit the perfect systematic back test of a rules-based process, but rather interesting. And we want to be that resource and continue to build strategies for clients that utilize those type of funds.
Yeah, I was going to ask you about those options or derivative-based products and structured products, and get your take on them and see what you thought about those, because that's also been another really big trend in the ETF development space.
Mm-hmm. I think there's definitely more players in that space. It's growing. I think it'll continue to grow. I think the narrative now has become just buffered exposure. I think it's going to evolve into more structured outcome, I think is the more appropriate word. I love it for this reason. The way to get access to that historically has been, you go to a bank, they issue these structured product, advisors buy into it. It's got a 12-month maturity, and you give it to your client. Very expensive, heavy brokerage fee laden. The ETF industry, like it's done really well in a lot of areas, has come into it and disrupted it and said, nope, here's a better way to do it, lower cost. It's not that complicated. Get rid of the credit risk of the counterparty, and we're off and running. So I love it. Love the concept. And there are products like this, but they've been more boutique-y, but like tail risk hedging, vol hedging products are coming out. I see them, but I think whoever really nails that whole suite structured outcome products in a very eloquent, simple way to explain it to clients is going to do very well.
Starting out 2024, just kind of current environment. Curious what you see out there, where you see opportunities, whether it's, value stocks or growth or tech or EM debt. Kind of a open canvas here for you. What's kind of top of mind for you in terms of asset classes?
I favor small cap a little bit. It's got some things going for it. Just we're at new all-time highs in a lot of the major indices, but I think the Russell's some 15-20% below its all-time high. Maybe it's going to come up the back of this race and accelerate. It had really strong momentum coming into the year. Q4 was great. for small cap stocks. The valuations still look cheap. Instead of a rough few years, because anything that is a large mega cap growth. So I like small cap for those reasons. I think it's just opportunistic. If we run into a rough market, I don't think it's going to be. I think it's going to show its kind of high beta and go down, but opportunistically, I think it's a good asset class. I like EM debt. I like just EM in general. Similar story. China's such a major component. International equity indices or emerging market equity indices. And it's been among the worst performing countries for a few years now. And if anything turns around in that market, you're going to see emerging market equity really outperform. It's been such an anchor on the performance. So you're seeing talk of stimulus over there. I don't think they want to continue to let the stock market tank as much as it has. There'll be a time when they'll manipulate their way out of it. And I think you might want to catch that upward trend.
Do you have a take on India and emerging markets?
Not a super educated one. I mean, I think that the long-term narrative there of fastest growing democracy in the world just to me seems, that might be a place I'd want to invest. I don't understand the dynamics, the corruption, the large income disparity or wealth disparity. I know they're all issues because I've read other people's opinions on them. I don't have a lot of very intellectual personal opinions, but it seems like a strong market in the really long term, but I could see how volatility in the short term would be tough.
Fair amount of volatility. But if you want to learn more, reach out. We'll talk you through it.
Yeah, exactly.
And how about high yield?
It continues to be resilient. Super tight rates have come, like interest rates have come up, but yield spreads haven't widened at all. And I know they're not the same, but if you just think about the dynamics and the concerns for credit as, interest rates go up, credit and reinvesting and all of that becomes more expensive, I would have thought spreads would have widened, but they just haven't, especially when you consider a lot of the high yield companies are financials and energy. So it's a tough place to be, but it's been a very strong performer. So I fundamentally look at it as just kind of this hybrid equity fixed income approach, what it is. I think that's where it is in the capital structure. It's also a very trendy, momentum-y, if that's a word, asset class. That movement in spreads aren't super choppy. They compress when they widen, they compress when they widen. So it's a very good signal to use in determining whether to own high yield or not. So we have high yield. We're full exposure in the probably 3 or 4 strategies that focus specifically on that asset class. It's at weight or above overweight right now. Even with super tight spreads, I get it.
What's next for Modelist? What's your goal for 2024?
I think continuing that passion, and for us, we just want to prove it right. I think there is a need for what we offer for advisors, and just the conversations we're having now are reflective of that. So we'll continue on that mission, continue to make a really easy, understandable partner for advisors to help them build custom models. We want to be customized models for the fiduciary financial advisor. We want to bring research, bring the value and IP of researchers to practitioners and be that translation mechanism. So I think in the next evolution, and we've started on this, is really enable our experience via technology solutions. So an advisor can do their research without us having to explain it to them, be able to understand using different strategies within a model, what results show up in a back test of that combination, be able to get their trade updates, be able to go all the way forward, front to end of account opening and execution and assigning model portfolios to clients. So again, using that direct indexing experience, we want that workflow. But for custom models, I give people a better suite of solutions and doing it themselves or outsourcing it.
That's great. That's good. Well, best of luck and continued success. One of the ways I like to close out the podcast is ask my guest about long-term trends that they see. This can be about everything that we've talked about, or it can be about something else that's just kind of totally top of mind, you think is cool, whatever. So what's one long-term trend you see playing out over the next year or several years?
I'll give you the top of the book part because I know that one. I just think the, customization for advisors, I think is going to be big, but at the same time, paring down their tech stack. I think people have gotten a little crazy with technology solutions in every aspect of their business that they're going to see some synchronization and consolidation of that. So I don't want to delve into that one because we've talked plenty enough about the whole customization side. But trends outside of that, oh boy. How about you? You give me one, and maybe that'll spark a thought.
Oh my God. I should be prepared for these more. That kind of.
You asked the question, and you don't even have an answer for it.
What is happening? This is going to be easy. Well, one of the things that's always top of mind, and I talk about it a lot, so this is kind of a cop-out, which is the aging of America and the needs for better retirement solutions, investments and otherwise for people, healthcare and all of that. I've talked about it before, dealing with trying to care with aging parents, and in my case, kind of remotely. And I don't know, I just think things could be better there, or I don't know what the innovation could be, but definitely open to something there. And I think that's going to have knock-on effects on the economy. Not sure yet how, but in terms of demand for certain types of investments or strategies, demand on impacts on the economy in terms of labor and labor shortage potentially, but maybe AI comes in there. So who knows?
Who'd Yeah, I guess a long-term trend, and it's been a trend for a long time, but just the growing deficit and level of debt that we have as a country. I see no glimmer of hope of any solution from any political party to try to tackle that. And it's ballooning and growing, and higher interest rates are going to make it larger. So I don't think that's a 3-month trend. I think that's the next decade trend. It's a problem now. It's been a problem for a while, but the more you ignore it, the bigger of a problem it's going to be. I don't have an answer. I don't have a solution. Might inflate our way out of it, but that's going to be a big, big topic. And how do you react as an investor as a result of it? Again, I don't know. But
yeah, that's a big topic a lot of people have talked about and raised. And you see dark clouds kind of out there, kind of out in the horizon, kind of coming, and along with other things like geopolitics. And not to go dark, but it's like some things we got to watch out for. I don't know if that just spells the case for gold. Just go into gold and hide out.
Well, that's the problem. As I said, it's just, you have those doomsday scenario folks that I think they have the right idea that it's going to be a problem, but when? And are you just going to sit in gold and build a bunker for the next 20 years? That's probably not a good answer. What do you do about it? You acknowledge it, but at the end of the day, you have a little bit of hope and faith that markets will figure themselves out.
Yeah. Outside of that, I think in a more positive light, I think the advances in medical care or genomics, things of that sort, I'm really enthused about and love to see more therapies out there for people for various issues. So, I don't know, bright future there, hopefully.
Yeah, I think that's a good one too. I think just cures for things like cancer and other, terrible diseases. There's lots of work being done there. Shout out to my wife, who's is a cancer doctor. So I get to hear a little bit of the inner workings of research and things in that field. But I think that'll continue to be a very innovative, in a positive way, theme. So maybe we can counteract our collapsing debt as a country with optimism of cures for cancer.
Yeah. So we've talked about a lot of different ideas and trends. I really don't have that many more to ask you about that I'd planned, but we do have a speed round called Trend or Fad, and this one could be real quick. But to kind of get your quick take on various things. One would be non-bank lending, trend or fad?
Trend. It's funny you say that. I actually have a close friend that has a great business model, but it's reliant upon a lending source to buy equipment. And it's not something banks would really touch, but it seems like a great investment opportunity for somebody who had that pool of capital. So that's why I said as trend. And then if more pools of capital, and if somebody can syndicate that concept really well, direct lending from individuals could be, just like we've seen kind of innovations in the venture side of letting smaller investors take part in that. If you do that on the lending side effectively, it'd be interesting.
Bitcoin, trend or fad?
It'll be a trend for a few more years. I personally feel it's a fad, but when I say it's a fad, I don't think it's going to go away.
And then finally, the 60-40 portfolio, trend or fad?
Oh, it's a trend again.
It's a trend again.
Yeah. That's such a fun rate. Like after 2022, 60-40 is done. Often when equities sell off, you expect bonds to be the hero. But if you look at what happened in both of those markets and where we sit today, we have yield again in fixed income. So it's an attractive asset class. There's actual yield to go with the lack of correlation and, duration. They're still highly correlated. Will we get through this Fed cycle of tightening, then, accommodative policy going forward? There'll be continued strong correlation between the two, but I think going forward, it's relevant to get.
Awesome. Joe, thank you very much. It's been a great conversation. What's the best way for people to learn more about you and Modelist?
Yeah, website modelist.me, M-E, or reach out at hello@modelist.me, and we'll get back to you. Or you can reach me at joe.mallen, M-A-L-L-E-N, at modelist.me. I think we got a LinkedIn page too, where we post some content, so feel free to follow that. Twitter, don't really keep up on, but we got one of them too. So you can look at that. I think it's Modelist_Inc. But email or LinkedIn's probably the preferred method.
Fantastic. Cool. A few different ways of connecting. Again, thanks very much, Joe. This is great.
Appreciate it. Thank you.
And thank you for tuning in to another episode of Trends with Benefits.